Fantastic. Hello, everybody. For those of you who haven't spoken to me yet, my name is Kanval, and I am your Protection Business Development Account Manager for Scottish Widows. So thank you for joining the call today. As Mohan said, he's kindly sort of organized this and he'll be recording the session as well. So for any of you who would want to revisit it, you could obviously listen to the recording. But for any advisors who've not been able to attend, they can have a view of the recording in their own time. And you're more than welcome to reach out to me directly, whether it is about the content that we covered or if there are any sort of questions that you may have about any pipeline cases or, just generally, if you're intrigued to kind of know what Scottish Widows is all about, give me a call and I'm quite happy to take that. So welcome, everyone. We know welfare reforms are changing and they're changing the landscape of financial support in the UK as well. So today we'll look at what these changes mean for your clients and why income protection is now more critical than ever. So my aim is that by the end of this session, you'll have practical strategies to help clients safeguard their financial future. If you've got any questions, because we've not got that many people on the call, so only around 14, if you've got any questions, just raise your hand or you're more than welcome to interrupt me. No problem at all. It's not like I've got 100 people on a webinar that I can't I'll have to park the questions to the end. So if you've got any burning questions while I'm giving the content, just raise your hand or put it in the chat or just come off mute and then ask the questions and we can address them as we go along. So by the end of this session, you'll have practical strategies to protect your client's financial future. So here's what we will cover today. First of all, we'll look at the impact of the welfare reforms. Then we'll explore why income protection matters more than ever. And then finally, we'll discuss how to integrate protection into long-term planning for your clients and also explore client objections. Now, the government support is shrinking. It's shrinking all the while, to be honest. But what does that mean for your clients? Now, the spring statement that was announced last year introduced stricter eligibility rules and lower payments, and there was a big push for self-reliance. Now, while these changes aim to reduce government spending, they create real challenges for anyone unable to work due to illness or injury. Most clients think that the government will look after them, but the reality tells a different story. Now, many clients, as I've been a mortgage and protection advisor myself, I've come across these clients as well who think that, the government will look after me, and then they assume that the government will actually take care of them when they can't work. But the truth is that benefits are limited and they're often delayed. And while some support is available, it rarely ever covers regular outgoings for very long. So people generally start off by using their savings to cover their mortgage payments, rent, and bills. That's followed by applying for state benefits. But the catch is that any income savings or even private pension payments that they may have, they'll actually reduce the amount of benefits that they get. Then we see that savings run out very quickly and benefits are capped. And this leaves households vulnerable and under pressure. Income protection, on the other hand, bridges that gap. It provides a reliable safety net and peace of mind when illness or injury strikes. Now, I'll ask a quick question, which will be answered on the next slide. We know that due to these benefit cuts, by 2029-2030, 3.2 million families will lose financially an average amount in pounds and pences per year. If I was to ask you, how much do you think they would lose on an average per year? Does anybody have any idea, because of the benefit cuts on an average, how much would they actually lose? I'll give some options there. Let's say, okay, so would it be £1,000? Would it be 1,720? Would it be 1,520? What do you think?
£1,000.
£1,000. Okay, let's see.
1,500.
Let's see. It's actually 1,720 per year. So we know that big changes are coming, and we just want to make sure that the clients are ready for the financial impact. And the spring statement that brought, obviously, that brought the changes to welfare benefits. And the aim is very much to cut the government spending and push for self-reliance, which means stricter rules for getting benefits, lower payments, and a bigger focus on employment. But the reality is on the screen here. Only 1 in 4 people fully understand the welfare reform set out in the last year's spring statement. And by 2029-2030, an estimated 3.2 million families will lose financially around 1,720 per year. And these aren't just numbers, they represent real households facing real challenges. And as advisors, this is where you guys really step in to help clients plan ahead and protect themselves. Now, these reforms aren't just policy changes, they will actually redefine financial security for thousands of households. Now, let's break down what these changes really mean for clients. So, personal independence payment, the entitlement rules are tightening. So, the government expects 430,000 future claimants will actually lose eligibility, with an average loss of 4,500 per year. Universal credit health element is also being halved for new claimants. So it's going to go down from £97 per week to £50 per week, impacting 730,000 future recipients. And that will be an average loss of around £3,000 per year. Employment support allowance, ESA, that will actually involve more frequent reassessments, and that will create uncertainty for those who rely on it. And carers allowance is actually linked to the other benefits like PIP and DLA and so forth. So if someone loses the entitlement to PIP, their carer will lose the entitlement to the carer's allowance as well. So these changes create significant gaps in income for clients who can't work due to illness or injury. And as advisors, this is where we step in, to help clients plan ahead and protect themselves. Now, when benefits fall short, income protection actually steps up. Income protection provides a reliable safety net when illness or injury prevents work. It's not just about covering bills, it's about maintaining financial stability and reducing stress during those difficult times. Now, I'm just going to ask a quick question again. How many people in the UK are estimated to be unable to work due to long-term sickness? Do you think 200,000, 500,000, 1.8 million, or 2.8 million? Anybody wants to have a guess?
2.8 million now. Yeah.
So let's go for it. Absolutely right. Did you see my slides beforehand? Did you?
You just go for the highest number.
Yeah. Why not? So here's the truth that you can see on the screen. 2.8 million people in the UK are unable to work because of long-term sickness. And that's not a small number. It's a real risk for every household. And yet only 29% of people believe there'll be enough support from the benefits after these reforms. And even fewer, only 25% feel optimistic about their future finances. Now, this tells us something really important. Clients are worried, but they don't always know what to do. And that's where sort of you as advisors come in, because you can really help them plan ahead with solutions like income protection. Let's look at what really happens when someone doesn't have income protection and can't work for an extended period of time. Most people think that they'll manage with savings or state benefits, but the reality is stark, and you can see that on the screen. 7% of people admit they won't be able to support their household at all. 22% don't have enough savings to cope with a financial emergency. And nearly half, 47%, could only support their household for up to 6 months before they run out of money completely. And what happens after that? They'll be left with tough choices. What are they going to be cutting down on? Would they have to cut down on essentials, food, clothing, or would they need to start relying on borrowing or relying on a partner's income or ask for family and friends for money? This isn't just about numbers, it's about stress, it's about debt, it's about rushed returns to work. And income protection absolutely changes that story. Instead of a short term patch, it provides a long term safety net that'll help the bills keep paid and lifestyles intact. Ask your clients, if you were off work for 6 months or so, how long would your savings actually last? And what is it that you would actually cut down first? This question often reveals gaps that they didn't know that they had, and it opens the door to a meaningful conversation about protection. And one thing that I'd always say, and I was guilty of it as well when I was an advisor, is that silence is golden. We often as advisors ask these really lovely open questions and say, okay, please, so you've got 6 months full pay and 6 months half pay. What would happen? What areas of your what are the things that you'd have to cut back on after that? How would what would happen? And we kind of answer the questions for them rather than actually proceeding with silence, because silence actually quite golden, in these sort of situations, because that really gives the time to the client to actually think about that situation and what they would actually cut back on. And then when they actually answer the question themselves, you can use their own words to explain that, okay, you've said that this would happen, so here's the solution. We'll talk about this. So yeah, please don't be frightened of silence. I used to be, so that's why I'm just bringing that up. So stress and mental health are now leading causes of long-term absence. The good news is that we never decline an application due to mental health disclosures. It's like it's never going to be a computer says no sort of situation. A human underwriter would look at the case themselves, before deciding whether we can offer terms or not, rather than a computer says no kind of decision, because every mental health situation is unique. In fact, for income protection, around 21% applicants actually disclose a mental health condition, and 88% of decisions are made at point of sale with us for IP. With mental health disclosures so there's a very, very high chance that it wouldn't even come to an underwriter because they'd be made on point of sale. And out of the 88% of applicants that were offered cover with us, 38% of those that disclosed mental health disclosures were offered standard rates, and 49% with an exclusion. So having mental health illness doesn't necessarily mean that they're not going to be covered. We do try our best to understand the client situation, and where we can actually offer standard rates, we would do. Where we can actually rate rather than exclude, we would prefer to go that way. Now, the government would look after me. Generally, that is a very, very common objection. But how much are your clients actually likely to get in statutory sick pay? Does anybody know how much statutory sick pay is and how long it's paid for? Anybody?
118.75 a week for 28 weeks.
Oh, well done. Well done.
Taxable as well.
Absolutely.
Most people
Spot on.
forget.
Yes, spot on, spot on. So yeah, 28 weeks. So the government will look after me that we get. Will they really? Based on what you can see on the screen. Let's really sort of look at the reality behind that statement. Now, statutory sick pay, as you said, Gary, It's only £118.75 per week, and it only lasts for 28 weeks. Contribution-based ESA, that's capped at £138 per week, and it's only claimable for a year. Homeowners may get help with their mortgage interest, but it's important to remember that that is a loan and it must be repaid. And there's a 39-week waiting period for that as well before you even see a penny. Bereavement support sounds quite generous, doesn't it? But is it really? The maximum payout is only 9,800 spread over 18 months. Now, compare that to income protection. That's a consistent, reliable support that lasts as long as your client needs it. Now,
One
this is
thing you have
yeah,
missed out on
yeah,
that,
yeah.
that is only payable if you're a PAY employee. If you're self-employed, you're not eligible to that 118.75. You get absolutely nothing.
Nothing,
And I speak
definitely.
from experience. When I was sick last year with my cancer, I wasn't entitled to a single penny from the government because I was self-employed.
Wow,
Not a
exactly.
penny. I was borderline for a PIP, but self-employed, absolute zero benefits.
Absolutely. It is appalling, isn't it? Because obviously
Yes,
self-employed is a I mean, they've got an even greater need for income protection, to be honest, for those reasons that you've mentioned. And I totally agree. I mean, my son is severely autistic and he is going to turn 18 soon, 24th of March. So he is in a residential school at the moment, but apparently some things like they're changing hands, as in NHS is going to fund his residence now and not the education because of the age bracket that he falls under. So apparently, I was sent a letter to tell DWP that that's the case. So I rang. You won't believe it. It was an hour after I got through over the weekend, not weekend, Friday, and I was like, oh my God. And then when I got through to them, they said, oh, we'll have to stop his benefit totally, which I'm sure they're not going to stop it because my son's severely autistic. But I said, okay, that's fine. They were only paying him about £300 anyway. But it's like, I'm just thinking for somebody who just can't speak, who is got a mental age of 2 years, they were kind of they said, oh, well, we'll stop it before we've done all the investigations. They are genuinely becoming really tight with everything. So yeah, you're absolutely right, Gary. You kind of realize that when you're in that situation, you're put in that situation that it's nothing. And thank you for sharing that story. I hope you're recovering well from your cancer as well. So if we were to compare the income protection, obviously that's a consistent and reliable support, and that lasts as long as your client needs it. And this is the difference between surviving and maintaining financial stability. Obviously, and as advisors, we can really help clients understand that relying on state benefits, it's not a solution, it's not a plan, it is actually a gamble. And we as advisors would never advise you to just gamble blindly. Um, this slide's actually really, really useful. I'll explain that, but you could actually use that to, have good conversations with your clients as well, because it kind of demonstrates that a small change in take-home pay can prevent a big financial shock. Now, let's put the numbers in a real-world scenario. So we've got two options side by side over here for the same person who is 35 years old, male, non-smoker, works an accountant, so that's an occupation class 1. They are paying student loan at plan 1 as well and contributing 3% to a pension. So option A is the do nothing approach. So gross salary, £50,000, monthly take home, 2,866. Now, if he becomes ill, he gets 4 weeks full sick pay. Then it drops to statutory sick pay, which is around £515 per month, that you can see on the screen. And then the income falls to zero when statutory sick pay ends. Now, if you look at the chart, from month 5 onwards, the cash flow totally collapses. And that cliff edge is what creates debt, stress, and rushed returns to work. If you look at option B, that is the protect and plan route. So over there, the gross salary is slightly less, 48,200. Monthly take home, 2,781, so slightly lower upfront. Same 4 weeks full sick pay, but then a full term income protection benefit of 2,410 per month. That kicks in from month 2 and continues while he's unable to work right through to the end of the claim term. Now on the chart, you'll see a stable level income line at 2,410 per month, and that will be month after month. Now that stability is the difference between coping and crisis. And what's the trade-off if we were to compare? The take-home reduction in option B is about 3%. So that's equivalent to £85 per month. In exchange, you remove that income cliff and you secure 2,410 per month if the client was unable to work. In fact, we did this quote back in sort of August, September last year. And at that point in time, our quote showed £80 and 91 pence delivers full-term IP to age 68 for this client with a 4-week deferred period. So £2,410 monthly benefit. If you were to really think about it, that's very powerful value for a predictable safety net. And let's just imagine
those slides
are
absolutely brilliant. If we had that as a tool in a calculator from your website that you could present to a client, that would sell income protection. You would have no objections. What customer's not going to take option B?
Exactly.
But it's putting in their income, what their sick pay is, and how a full-term IP would work. But then equally, you've probably got option C, because really you should do that on indexation. So you would show then an increasing step going up over the years.
Exactly. Countering
with RPI,
inflation.
say at 3%, for example. And but if a customer was to look at that, forget all your key facts, all your other quotes and everything. If you gave that to a customer and said, right, this is what you've got with your employer, and that's what you're looking forward to, or you can do something and you can have option B or option C, it would sell the policy immediately.
Exactly.
So we need your development team to get a calculator that would produce us something like that you can present to a customer. It will sell IP without anyone querying it. They'll just take it, and the £85 I would consider a low premium.
Exactly. For the stability that you're getting.
Yes.
For sure. We built these slides last year, and the development team are kind of constantly working on the tools that they can provide. The only thing is, obviously, every client's situation is going to be unique, and their deferred period and their sick pay arrangements would be unique. So it wouldn't be possible to do that. But even if you're kind of just demonstrating it to the clients with their income, you could pretty much sort of draw something that would kind of explain them, and you can kind of share the slide, and this is just an example that you could kind of do their own scenario based on, I used to do a lot of things. Drawing is not my best subject, but that kind of helps. I mean, doing a lot of calls on Teams, there's a lot of tools that you can actually use to demonstrate something like this. Just draw with a note, with a pen, and just use the slides, but with their own income, and that can depict it. But good point, Gary. I'm definitely going to feed that back, because we do meet on a quarterly basis. So these are good thoughts, that come from advisors that we can actually put through to our development team to actually help devise more newer products and tools that can support with the conversations. But no, great point. Thank you. Now, let's just have a look at the objections. I feel obviously behind every objection, there is a bit of misconception as well from the clients, and it's an opportunity to educate. Clients often have reasons for not taking income protection, but let's just look at the reality behind those objections. So, firstly, you'd have clients saying, "Oh, I have savings to fall back on." But the truth is that 22% of people don't even have enough savings to cope with a financial emergency. And even those who do often underestimate how quickly those savings disappear when income stops. Um, you know, ask your client, if you were off work for 6 months, how much of your savings would be left? And what would you cut back on first? And again, as I said, silence is golden. Let them answer that. And then a very common one that we get, it won't happen to me. I'm sure we all have encountered one client, at least, who thinks they're invincible. Nothing's going to happen to me. Raise your hands if you have. Anybody? Oh, you've got you've got people who don't think they're supermen, superwomen. Okay. Well, we do tend to get clients. Yes, Brendan. Thank you. Yeah, we do get clients, and this is one of the most common objections. But the reality is that 2.8 million people in UK are unable to work due to long-term sickness. Illness doesn't discriminate, and it can happen to anyone. I can say that because the son that I was speaking to you about, my son who's nearly 18 now, 3 years ago when he was 15, he was diagnosed with cancer. So he suddenly had a lump on his neck, and it sadly was diagnosed as lymphoma stage 4. Thankfully, he's all right. He's in remission with the advancements in sort of medication. So, he had chemo and he's fine, thankfully. But that just goes to show that illness doesn't actually discriminate. It can happen to anyone. And 59% of people are already concerned about losing income if they can't work. So the risk feels distant until it actually becomes a reality. And then we hear, "Oh, I don't need it." But 68% of the people who hold income protection say that they actually took it out for financial security. It's not about expecting the worst, it's about planning for the unexpected. A great way to frame this would be, would you rather pay a small, predictable cost now or face a large, unpredictable risk later? And then another one is, I'll do it myself. DIY financial planning sounds really easy until life throws a curveball. And I can give you a personal example over here. So, 4 years ago, I got a pet cat, and I didn't really know much about pet insurance. So I went online, did my DIY financial planning. Didn't feel that okay, I should really consult a friend of mine who has got cats and insurance. But anyway, I went online, got the pet insurance, and then ticked on an add-on for cancer, thinking, oh, that's going to be really important, etc. And I thought, okay, I'm sorted. I've got the best plan for my cat if anything was to happen. And then last year we put our cat in the cattery when we went on holiday. When we came back, my cat was not eating very well, so we had to take him to the vet. When we took him to the vet said, "Oh, well, I think he's got some dental issues, so we may need to do some dental extraction." I thought, okay, that's fine. In my mind, I've got the best plan and it will actually pay out for the dental cover. So I come home, I ring up the dental insurers, the insurance company. And they said, "Oh, you know what? You forgot to take the dental cover, so it's not included." And I'm like, "Really?" So, the doctor had quoted a cost of £3,000 for the dental work. So DIY financial planning can be very costly. Half of the people generally prefer to speak to someone when they're managing finances because emergencies are stressful and complex. Um, ask your client, if you were off for 6 months, what would your plan look like? And how confident are you that it would cover everything? Now, that question often reveals gap that they didn't know that they had. And finally, you guys are there, you're qualified, you can give advice. And not only that, you'd know what insurer is probably going to be better in your client's conditions, especially if they've got pre-existing conditions. Do they really want to risk answering questions incorrectly? Because you can make a mistake when you've got nobody to guide you. And then finally, I think I already have protection. Oh, yeah, we get that so often, don't we? I used to get that for every single mortgage review that I'd get. Oh, I already have protections. And the fact is that over half of the people, 53% of them, have never heard of income protection and they don't know what it is. Many confuse it with life cover or critical illness. And this is where you all can add real value. Clarify what's covered and what isn't. I used to do that in terms of with my, whenever I had a mortgage review, I'd ask for their pay slips beforehand to be emailed, but equally, I'd also ask for their existing cover details emailed to me because that's a major part of my recommendation. And that gives them peace of mind as well that this person's not just here to sell. And I'd just say that, okay, well, we'll see what cover you've got, and great news that you've got cover, Mr. Customer, but I'll check what you've got. If it is sufficient, there's no shortfall, great, you'll have peace of mind that I've checked it. But if there is a shortfall, then I'd be giving my recommendation. And a simple question works as well. If you couldn't work for a year, what would actually pay your bills? If they hesitate, that is your opening. So, in short, objections aren't really barriers, they're conversation starters. And when we address them with facts and questions, we help clients make informed decisions. Now, we'll talk about the role of income protection in long-term financial planning. Now, life plans can change in an instant. Are your clients really prepared for it? Now, we've got an example over here, Owain and Katie. They're like many of your clients, recently settled into their home, planning for their future. They're financially comfortable right now with a mortgage, and they have hopes of starting a family as well. And then life throws a curveball. Katie suffers a serious back injury and she's off work for 12 months. So on the right hand side, you can see two possible paths. So beyond the state benefit option, where Katie has no income protection. So she receives statutory sick pay for 28 weeks, which is around £515 per month. After that, ESA adds about £435 per month, and mortgage interest support comes in much later, and again, that too as a loan. Even with these, their income falls far short of covering bills. And after 9 months, they're struggling financially, and Katie returns to work before completing her recovery. Now, let's look at the next option, which is beyond the income protection option. So Katie had income protection with an 8-week deferred period. After statutory sick pay ends, she receives 2,213 per month, which is 60% of her gross salary. She also uses additional health and well-being benefits for rehabilitation, and that helps her to return to work on a part-time basis after 12 months. For 6 more months, she gets a rehabilitation income benefit to top up her earnings. And the difference over here is basically financial stability. The difference is better recovery and lesser stress. This slide really sets up the conversation as to which path you would like your clients to take. Definitely, it would be the income protection option for most of you, I would like to assume. And this is cash flow planning tool. Are there any wealth advisors, any financial advisors on this call, or are you all mortgage and protection advisors?
No, yeah, I'm a IFA.
IFA, yeah. So I'm sure you're familiar of cash flow planning, and that is also a very good tool that you can use for IP. So right now you can see on the cash flow planning for Katie and Owain, everything looks fine. But what happens if income stops? is what we'll look at the next few slides. Obviously, here is their current financial picture. So Wayne and Katie are comfortable. They're managing their mortgage, and they're managing the bills as well. They've got 2 incomes. This is the baseline. So what life looks like where everything goes to plan. But the question is, what happens when it doesn't? So this slide actually shows the current scenario with this, and then relying on state welfare on the right. So on the left, you can see Katie and Owen's current income when life goes to plan. On the right, you can see what happens when illness strikes and they've chosen to rely on the state benefit option. So as soon as the sick pay ends, you can see a shortfall in pink. The black line is what they need to maintain their lifestyle. So ask your clients, what would they cut if that was to happen? Food, clothing, kids' activities? What would they sort of borrow from friends and family? And then one decision just completely changes everything. So on this one, we've got the current plan snapshot along with the income protection policy option on the right. So this slide shows the same scenario as before, but with income protection in place. And the difference is striking. On the left, you can see Katie and Owen's current income when life goes to plan. On the right, you see what happens when illness strikes and they've chosen to protect themselves with an income protection policy. So after a short deferred period, Katie receives 2,213 per month, which is around 60% of her salary. That income continues for as long as she is unable to work, providing stability and peace of mind. Plus, she'd get rehabilitation benefits as well that would help her recover faster and return to work part-time without financial pressure. And then look at the chart here. Instead of a steep income cliff like what we saw on the last slide, there's a steady, predictable line. That stability means bills are paid, the mortgage is covered, and Katie can focus on recovery. She won't have to rush back to work before she's actually ready. This is the conversation that'll turn, I'll think about it, to let's do it. Ask your clients the question that if you had the choice between a sudden income drop, oops, sorry, my screen's just switched off. Can you all hear me fine?
Yes.
Okay, perfect. So it started now. For some reason, my screen just went blank. So, ask them if they had a choice between a sudden income drop or a steady safety net, which is the one that they'd choose. So let's have a look. So the cost of protection is actually quite small to the cost of being unprotected. Clients often ask, how much will it cost me? And the answer might surprise them. So for Katie, a full-term income protection policy providing £2,011 per month up to the age of 68 costs just £55.20 per month. Now that's roughly 1.6% of our gross income or 2% of our net income. Now, think about that really. For less than a price of a takeaway each week, Katie secures a safety net that could pay out for years if she was unable to work due to illness or injury. And compare that to the average length of an income protection claim. How many years? That's a question for you guys. How many years do you think is an average length of income protection claim? How long do people generally claim for on an average?
About 7 years.
Good, very, very close there. So yeah, the average length of an income protection claim is actually 6 years, 9 months. So, that's nearly 7 years of financial stability for a small, predictable monthly cost. And, this is the conversation that'll really reframe protection as value and not an expense. Ask your clients, would you rather pay £55 per month now or face the risk of losing thousands every month if you couldn't work? The numbers actually speak for themselves. A tiny percentage of income today prevents 100% income loss tomorrow. And then financial protection is just the start. Clients actually need holistic support for life's toughest moments. This slide highlights why additional support services matter more than ever. It's not just about paying claims, it's about helping clients through the challenges that come with illness and injury or bereavement. Um, Red Arc data shows the breadth of issues that the clients face. So, cancer accounts for 29% of support requests. That's then followed by mental health at 13%, cardiac conditions at 8%, and then orthopedic issues at 7%. And this support isn't short term. 22% of customers receive help for over 6 months and 12% for over a year. These services include access to a personal nurse advisor who can offer emotional support, they can offer practical guidance, they can even arrange a second medical opinion that gives clients confidence in their treatment plan by connecting them with UK consultant specialists. If ask your clients if they were facing a serious health challenge, would they want more than just a payout? And this is where income protection adds real value, financial security plus expert care when it matters most. And then we do have Square Health as well that comes with all sort of Scottish Widows Protect policies. So that gives them expert care anytime, anywhere, because health issues don't wait for office hours. Income protection, again, I would say, is not just about money. It's about access to care when you need it most. And with Clinic in a Pocket, clients and their families can speak to a GP 24/7, often within 30 minutes. And they can also write prescriptions for the clients that can be delivered to their door, or, to their door free of charge. And for a small fee of £15, they can also get fit notes and specialist referrals. With our income protection, if we do have an immediate payment facility for income protection claimants. So what generally happens in the market, and I'm sure Gary would be able to relate to that as well. Normally, if you have got income protection and you go for a 4-week deferred period, generally speaking, in the industry, the insurers, they would start collecting evidence, they'll write to the GP, they'll start doing their investigation, and that may take over 3 months to decide whether a claim is valid or not. If the claim is invalid, they backdate it to the 4 weeks period. But if if it's declined, then the client's not paid anything. So essentially, obviously, yeah, they do backdate it, but that defeats the object of having a 4-week deferred period in the first place. So what we do differently is that we've got an immediate payment facility. So if your client, they can use essentially the virtual GP, get them to write a sick note for a mere cost of £15 if they're struggling to get to their NHS GP to get a sick note. Send that sick note over to our claims team, and the claims team will start making their up to 3 monthly payments after the deferred period ends, while we do our investigations to see if the claim is valid or not. If the claim is then, we've got all the evidence and we say, okay, yeah, that's fine, the payments will carry on being paid. But if for any reason we say, okay, no, it doesn't meet our definition, we can't pay, then we won't ask for the money that we've already paid to them unless it's fraud or misrepresentation. But yeah, that is obviously another benefit of it. So you can use essentially the Clinic in a Pocket, get a sick note, get your claim going, and get it sorted. And often we have clients with children. Ask your clients, if you or your child needed a GP appointment at 10 p.m. on a Sunday, how valuable would it be to speak to someone within 30 minutes? Would having unlimited access to a GP for whole of your family without paying anything extra make a difference to you? And then lastly, we'll come to your questions in a minute. But before we do that, I'm just going to sum off what we did. So today we have achieved all of this that you can see on the screen. We started by looking at the impact of welfare reforms and how they're reshaping financial support in the UK. We then explored why income protection matters more than ever and how it can safeguard your clients. Um, we also discussed practical ways to integrate protection into long term financial planning and how to handle common objections with confidence. And the key takeaway would be that income protection isn't optional, it's an essential. And your advice today can make the difference between financial resilience and financial vulnerability for your clients. So that sums it all off. Let's go for question and answers. Any questions at all? Everybody's very quiet. I'm hoping you're all awake still.
I'm still here. I think, as I said earlier, the
Yeah,
importance is it's all very well just producing a quote and an
yeah,
illustration.
yeah.
What we need part of that is then the warning to the client and say, right, as you're employed, are you aware you're only going to get this? Or you're not going to have this? Or, yeah, having some sort of a calculator that
Mm-hmm.
can show just what they're going to lose.
Mm.
Because when people can see what the consequences are of not doing something, they'll do
Yeah,
something.
yeah,
But unfortunately, they'll all bury their head in the sand. And most people will turn around and say, oh, no, I've got very good sick pay with my employer. And then when they do come back and they found out what it is, they say, oh, yeah, I've been told it's SSP. And I say, really? And they
exactly.
say, is that not good? And I say, well, yes, if you can live on £118.75 a week, it is good. But you
Eh,
tell me how you can afford that. You can't even afford your mortgage.
Exactly, and that
It's
too just for 28 weeks. I mean, yeah, I mean, for most of the people, it wouldn't even cover their mortgage,
no,
let alone
the,
other
the
bills.
safety net has completely been dismantled by the
Yeah,
government.
yeah,
And the average consumer isn't aware of that because they think there is still a safety net. So we need some sort of a calculator that can show just what that customer's going to lose. If they
yeah,
get sick pay for 6 months and then half pay for 6 months, and you key in their income, and the calculator then works out and says, this is what you're going to lose.
yeah. I like your idea. If there was
That
like, let's say, for example, a little a tool where that slide that we were on before
yes,
that showed, if there was a tool, like for example, that you could
that
just enter the client's sick pay,
absolutely.
and then it just did that
If that
graph.
could be incorporated into an illustration,
Yeah,
and
yeah,
it follows on at the very end of the illustration and say, right, this is the cost of not doing anything or doing something. And
yeah,
you demonstrate that, people won't care about the premium of £85, £100.
yeah,
I mean, I've got some people that pay in excess of £100 a month on income
absolutely.
protection. Um, and I say to people, we don't look at the cost, it's about your safety net,
Yeah,
what's going to keep you going. And I will say to people about my own situation. Fortunately, I have all my commissions coming from Julian Harris that kept me going.
yeah,
But and I said, when I had my cancer diagnosed in 24,
yeah,
yeah, Macmillan helped me. They went through everything, and I wasn't entitled to a single penny in benefits. I thought I knew that, but an expert looked at it, and I wasn't entitled to a single benefit.
yeah,
I got absolutely nothing because I was self-employed.
yeah,
Any self-employed client, if they haven't got income protection, we've let them down. We
absolutely.
we have failed them 100%. Yet we're flogging their life cover, their DTA or their kick, because it's an easy sale. But most people, IP is not an easy sale.
Yeah,
But that slide, if we could get that onto an illustration or even a separate document,
yeah,
it would be so, so powerful.
very.
And customers won't look at the premium. They'll look at, well, this is if I do nothing, and this if I do something, which would I choose? Well, I want to choose the safety net option.
Yeah.
And you say, well, it's going to cost you this.
No.
Do they care? No.
No. No. It's a value, isn't it? They'll see the value in it, and that's the main.
Absolutely. It's
Yeah.
no different than someone booking their flight with EasyJet and they don't stop at the basic premium. They then want to add, I want to choose where I sit. I want to take,
I want baggage.
luggage on board. I want carry-on luggage on board, and I want to have a voucher to buy some food and drink on board.
Yeah.
And suddenly, the cost has rocketed up.
Yeah.
Because it's what people want, because they realise that the benefit of buying extra bits. And that's what we need to do with income protection.
Absolutely. No, that's great. That's great. Thank you so much for your input today as well and your participation, Gary. Any other questions from anybody else? Oh, well, no, that's fine. So what I'll do then, I'll send an email with a summary of what we've discussed and a copy of these slides. So obviously, I'm definitely going to feed back to our sort of IT team that design tools, etc. It's not going to happen overnight, but it's definitely a good call, Gary. But until
you're
then,
welcome.
you can.
I would welcome having a chat with you sometime about the flexibility of your product.
Yeah.
Because when I compare it to the flexibility of Aviva, yours wouldn't even score 5%.
Oh, okay.
Because income protection, people say they're flexible, but that's a lot of crap. They're not really flexible. I've got one lady, she had a hysterectomy, she's had her claim paid, but now she can't find work. So she's can't keep her income protection going because she's got no income, but she's now fit to work.
Okay.
So it's little things like this. And if we sell IP to ladies, young ladies, the chances are they'll stop work and have babies. And what do we do with the income protection then? How flexible is it to females that go on maternity leave? I've got a lady having a baby at the end of this month, and she's an NHS nurse. But at the end of the day, that's where the flexibility isn't there. And RPI index linking, again, most insurers, as soon as you decline it, it's never offered, or you can decline it up to 3 times in the lifetime.
With us,
Aviva
I
is
think we had
every
this
year.
conversation, didn't we, Gary, previously? So with us, you can decline it 1 year and not decline it the other year, and then you can carry that on for the life of the policy if you wanted. If you
So it's every other year.
Yeah, if
You've got to
you
let
can
it
even
go up.
decline, you can even decline it 2 consecutive years, and that's perfectly fine. But you can't decline it 3 consecutive years, because if you decline it 3 consecutive years, we'll just assume that you're opting out. But you can always decline it 1 year and not decline it the other year, and you can carry that on for the full life of the policy.
Let's look at consumer duty then and how this fits. I like to throw big pebbles in the pond. We got someone that's an admin worker for a very small employer and only works part-time, but she doesn't get a pay rise. She's got income protection and it's given her her £1,000 protection that she needs, but she doesn't get a pay rise. She's on maximum benefit. So if she allows the policy to index link, then she's going to be paying for a benefit that she can't claim on. Does that meet consumer duty? Some insurers have a little bit of a safety net, but if she went 3 or 4 years and the small employer didn't give her a pay rise, then she can't allow a policy to index. So this is where insurers are really unflexible to the consumer. Now, if they work for the NHS or the police or someone, that's fine because we know they're going to get a pay rise every year. So if they decline index linking, that's their personal choice. But many people don't have the choice about not having a pay rise. They don't get one. And so therefore, if we've set it on maximum, which we can't do anything less than set it at maximum, how does that meet consumer duty and meeting the client's needs and treating them fairly? I think it fails. And that indexation option, I think it needs reviewing. But that's my
Obviously,
own
in
personal
that case,
opinion.
in that case, though, obviously, if their salary is not going to increase at all, Gary,
Yeah,
then if let's say they were never off sick, their salary is not going to increase. So you wouldn't be then going for the indexation model, because you know that if you go for the indexation model, they're going to be paying for a cover that they're not going to be able to claim. So you'd go for a level cover in that case, because you know that their salary is not likely to
yes.
increase.
But who knows when they start working for their employer that their salary is not going to increase?
But
Most
then you have
people will hope
GIOs.
that it will at some point.
Yeah, but then that's where the GIOs come into effect. So the
Yeah,
guaranteed insurability options that, I know not
yeah,
all insurers have that, but to meet consumer duty, that's where we've got guaranteed insurability options that you can exercise if you do have an income
yeah.
increase. They can increase it that way. So, the flexibility is there. I'm more than happy to pick this up with you
Yes, no,
later.
we can
It
have
would be good.
another chat at some point in the coming weeks.
Yeah,
Because I'm
absolutely.
very passionate about this. This is that I sell more of this than I do life cover.
Yeah, no,
Because
that's
it's
true.
the one product that is so undersold, but most people don't fully understand, the key benefits and all the features that they provide. But I like your slides. That if I had those, it would make my selling of IP even easier.
That's lovely. That's lovely to hear.
Yeah,
I'm going to send them over, and for sure we can obviously definitely catch up. And I hope you all have found the slides useful. And as I said, I'm a firm believer that every insurer has got its their place in the market. And naturally, if you're going to sell more IP, we're going to get a share of that anyway. But if you want to know a bit more about what our IP proposition, what our USPs are, quite happy to discuss those. Just like we've kind of had Gary's touched upon a few bits as well. So quite happy to do that with you all individually as well if you wanted. Okay. So yeah, thank you so much. Thank you for arranging this one. Really appreciate
Thank you,
it.
Hannibal. Yeah, that's great. Thank you for a very informative webinar.
So CPD certificates will not be issued by myself, because obviously I don't have your details. This call was arranged by Mohan. So I don't know, Mohan, how do you go about that?
Anybody that wants CPD certificates sent, if you could just put your email in the chat section, and then if you don't mind, just send them out directly to them.
Yeah. So I'll need the full name and the email address.
Okay.
Okay. Fantastic. Lovely. Thank you very much for your time then, guys.
Great.
Take care
Thank you
then.
very much. Thank
Bye.
you.
Bye.
Bye. Bye. Bye. Bye.